Welcome back to the Raw Selection Private Equity Podcast. On the podcast today is Randy Cohen and Jean-Louis Lelogeais, founders of PEO Partners, a liquid private equity firm. Randy is a lecturer at Harvard Business School, and Jean-Louis is the previous co-founder of SVP Global. We're going to dive into their experiences in both those businesses, but predominantly diving into what is liquid private equity. Randy, if you can share a brief insight into you, please.
I'm Randy Cohen. I teach finance and entrepreneurship at Harvard Business School. And with my dear friend Jean-Louis, I'm a co-founder of PEO Partners. And we're a platform for creating liquid private equity for various uses that I hope we'll get a chance to talk about today.
Thank you. Jean-Louis, you can do the same.
Yeah, I among other things, I co-founded SVP Global, which is will be about $26 billion distressed debt restructuring turnaround firm, focused on drawdown vehicles. So know a little bit about private equity from the other side, and stepped down from my day-to-day role at SVP about 6 years ago. It's been a privilege to be working with Randy on this innovative idea, which we call liquid private equity. Obviously, two words that don't usually go together well, but we'll explain it.
Sounds like a lovely oxymoron. So let's kick off. What is liquid private equity?
It was going fresh on the week.
Yeah, Randy, go for it.
All right. So the idea of liquid private equity is that private equity has been the most attractive investment from a performance perspective over the last, honestly, generation, maybe two generations, since the 80s or 90s. And so that is fantastic. But in the year 2000, I gave a talk at Harvard Business School, and I said, look, given how extraordinary the performance has been, which is to say consistent, average outperformance of equity markets, but with much less volatility, and in particular, when the market crashes, private equity reports significantly lower drawdowns than the equity markets. You almost wonder why it isn't even bigger than it is. And of course, it's grown tremendously since then, but still a single-digit percentage of the capital markets. And of course, the issue is there's an issue of access, where about half the money in the world, frankly, sort of can't really invest in private equity, but also an issue of liquidity. Even the people who do invest in private equity have real challenges around managing capital calls, return of capital, and the idea of a liquidity buffer or funding asset. And so the notion was to create liquid private equity, say, let's look at all the things private equity does that add so much value and see if we can do most, if not all of those things in the public markets, so that we can offer a liquid vehicle with daily or even more frequent and then ETF, type liquidity, and nevertheless get people that really attractive private equity performance profile.
Jean-Louis, what would you add to that?
No, I think that's exactly the premise. The goal is to get to providing a performance profile that is akin to average private equity, which is to say, if you look at since the turn of the century, private equity, if you look at the Cambridge Median Index, which is kind of often for US, you'll see that private equity has delivered about 12% net of fees, which is an extraordinary performance. If you look at the S&P over that same period, the annual performance has only been actually shy of 8%. So that's a massive outperformance to private equity that private equity has delivered. And the other thing is that delivered that was half of the volatility of the public equities market, just because you get you get capital accounts every quarter. That's how private equity firms report. And they do mark-to-model accounting, and so it never crashes in a crash. So the idea of Liquid P is to try to deliver that performance profile, which is, call it outperformance to public equities, with a more muted drawdowns, like private equity achieves through mark-to-model accounting. And if we're able to deliver that average performance, we think it's a very attractive number of use cases for the allocators, and quite frankly, actually, potentially even for the GPs. We can get into that a little later.
Right. And, Jean-Louis highlights an important point. We can't outperform in the public markets. It's just not realistic. in the public markets with this approach to deliver the performance of top quartile PE. And obviously, that's what allocators are shooting for. So the idea of liquid PE is not in any way, shape, or form to replace even a dollar of anybody's private equity allocation. But it turns out it's incredibly useful for two purposes. For institutional investors and family offices that invest in private equity, what's great about liquid PE is you can use it as that funding asset, that liquidity buffer, the sort of cash that you need to hold that's ready to go out the door anytime in capital calls. It's a place to put money when return of capital comes in. And what we found is that allocators love their private equity, but they don't love the choices they have for a funding asset, which is sort of cash or a mix of cash and equities. They don't deliver the PE performance profile. And then the second group, of course, is people who can't access private equity at all. If you're a sort of moderately high net worth investor, you have a few $1,000,000. Well, you can't really, if you want to put 20% in private equity, you can't do it, right? 20% of $4 million is 800,000. You can't make the minimum at even a single private equity fund. And so it's not a very attractive situation for them. They're in 60-40 stocks and bonds, and they'd be way better off doing what institutions do, going to 50-30-20 with 20 in private equity. And so liquid private equity can offer that opportunity. But again, notice you're not taking any money away from private equity. The goal is to be supportive, and complementary to private equity rather than an alternative. Because if you're delivering average PE, that's very attractive as a complement, not attractive as a replacement.
Okay, so because one of my questions was going to be sitting around who your LPs would be on this basis. So you taking from typical high net worth individuals as well as your traditional routes of private equity does?
Over time, sorry, go ahead, John.
No, I was going to say, look, the premise, Randy and I are, our background is institutional, right? So we got to know each other as part of an institutional forum for the role of alternative investing in portfolio construction, and that was an educational forum and mostly focused on very large public pension funds. And if you look at those public pension funds, about 20 years ago, when that forum started, and Randy and I were involved, they were really they were very clueless about exactly how much to put in alternatives and how to think about portfolio construction. I'm talking about those very large public pension funds. So when we started PEO, I told Randy, look, the first thing to do is, because we thought, and we'll hopefully get into how we do it, what's the investment approach, but we knew we had the premise for developing that investment portfolio that delivers the performance profile net of fees, which I described, right? But I told Randy, even if we think we have it, I don't want to be two guys in our ivory tower falling in love with a creative idea that nobody's going to buy, right? So so what we did, and at this point we've talked to about 250 chief investment officers at sovereign wealth funds, at large public pension funds. And so the premise and really the rationale for launching the business is their feedback said, if you could build that portfolio, it would be interesting, right? And so we think a big potential for this business is going to be indeed the institutional investors. And Randy described it very well. All those big public pension funds, it's a nightmare for them to manage capital calls, returns of capital, right? Think about CalPERS or the state of Oregon or ADIA, and all those very large organizations are invested in Blackstone number 6, 7, 8, 9, 10, 11, 12. The same thing with KKR, the same thing with Carlyle, and on and on. And constantly, they never know when the GP is going to sell a portfolio company, and they get a check back, and then they only get 10 days notice, for capital call, right? And so that management, that cash management issue is a bit of a nightmare. And as Randy alluded to, most of them, when the consultants say put 20% in private equity, they don't want to be too many times at 20%, and they get a bunch of capital calls, and then they have to get money out of the equities portfolio, the fixed income. So they typically have a bit of a buffer. And they told us, boy, we don't have a good solution for that buffer. When we first started our calls, they were saying, half of them said we put it in cash. Cash at the time was earning 0. If you're trying to make 11% net, right, which is the average PE return I was mentioning earlier, and you're doing that on 20% of your portfolio, that's one thing. But if you're doing 11% on 18% of your portfolio, all of a sudden your net return is actually much less, right? And the other kind of half of the CIOs told us, well, it's equity we put in an S&P in an index fund, but that's not a great also solution because number one, it's going to underperform what you're trying to do in that PE bucket. It's going to underperform the 11% target, but also it crashes in a crash, right? In the global financial crisis, that 100 cents in the S&P would have been down to 50 cents at the trough. And you're supposed to kind of have that money available to make capital calls. So they told us, boy, if you do that liquid PE vehicle that you're describing, that would be much superior because, we get a capital return from Carlyle, we put it with you, we get a capital call from KKR the next week, we take it from you, and in the meantime, it kind of earns something that is in the zip code of what we're trying to do. So that was that. So the long-winded answer to tell you, definitely a huge institutional opportunity that we're pursuing. But obviously institutions, as you probably well know, they're very risk averse. They need to, they want to see a lot of assets under management, and we're still kind of early in terms of AUMs. We're just at about 250 million that we advise or sub-advise. So for a bunch of those public pension funds, they're saying, come back to see us when you have, 5 billion, and they want the blessing of 3 consultants. So the other kind of opportunity set that is more in front of us right now is what Randy was mentioning, retail investors that don't have access to private equity. In fact, a lot of our assets are in a mutual fund in Canada, because retail investors in Canada, they don't have access to private equity. And so that notion of kind of what pension funds have done over the last 25 years is diversify from the 60-40 mix, right? 60% equities, 40% fixed income, which is your traditional investment mix. And they've gone to 50-30-20, 20 being alternative investing, and a lot of it being, private equity is a big part of it. In some sense, liquid PE gives you a proxy for retail investors to start migrating away from 60-40 to a more diversified mix and get, that sort of proxy exposure that's so valuable in terms of extra return and lower vol.
So, and I've done a lot of interviews on this podcast, and obviously we specialize in private equity for executive search. No one's ever used the term liquid private equity with me previously. Have you guys just invented something? Is this commonplace? And will we see a rise in this?
Yeah, so it's funny because I met Jean-Louis almost 20 years ago, and ever since we first started talking about this, we've been sort of half jokingly, half seriously calling it the $1 trillion product. Obviously, we don't expect PEO Partners to be a $1 trillion firm, but we do expect there to be $1 trillion in liquid private equity, and we launched this firm 6 years ago with that expectation, and that we're going to be a thought leader in the space, and we think that evidence is really mounting that this is going to be a super important area. And the big milestone recently was BlackRock's purchase of Preqin, which you may have read about. Preqin is a provider of private equity data. We've subscribed to Preqin in the past and used their data. It's not our primary data source, but we like to know about all the private equity data that's out there. And BlackRock paid billions of dollars, over $3 billion, to purchase Preqin. And the announcements that came along with it, they were very straightforward in the press release. They said, we think that the future is liquid markets versions of private products. And so we absolutely think that different ways of making private equity liquid and accessible, whether that is so as to reach the broader audience of investors who can't, invest in traditional PE, or for the specialized use cases that Jean-Louis was talking about in terms of functioning as a liquidity buffer. You can use it for a tactical asset allocation, for completion portfolio. There's fascinating things you can do with ESG. So it's got a million use cases. It's a tool in the toolbox for allocators. And so we absolutely think this is going to be enormous. And we certainly expect to see great things from BlackRock in the space, but it's not going to be just them. We've talked to many large firms that have indicated that this is something that they plan to pursue. And we say, welcome to the party. This is a great idea. As I say, I've been getting speeches about it for literally a quarter of a century. We launched our first product 4 years ago next week. And we're happy to see the traction growing because we think it's a really important idea for the investing world. Jean-Louis likes to point out that if you look at private equity, it's not an area that innovates super frequently. The last big innovation in private equity, we're not counting, subscription and redemption lines, just adding leverage as an innovation. The last real innovation was secondaries. That's like 15 years ago, right? That's during the global financial crisis. And that was a really important innovation. But it's time for another innovation, and we think we're part of that.
95% of all business problems are people problems in disguise. Over the last 6 months, I've been intently writing a brand new book, all focused on the experiences that I've collated from some of the top private equity firms and investors on how they interview and select top executive talent for their portfolio companies. To go on the waiting list for this book and receive a free copy for the first 100 added, please check out the show notes and get your name on the waiting list today. So talk to us about the strategy then. How's everyone probably listening, well, hopefully everybody listening understands private equity and what a private equity firm would do in its traditional phase: choose an industry or invest in every industry. For some of them, deploy capital into companies, hold them 5 to 7 years, exit those businesses, give returns to their LPs, and then go again with a larger fund and another press release from there. So how does liquid private equity work? Give us an understanding of your strategy and what you're planning on doing there.
So Randy, I'll let you kind of cover it, Randy, but I just want to make sure that we preface, Alex, that for purposes of this conversation, what we're focused on initially is leverage buyout. So sometimes, private equity includes gross equity, distress, private credit. Our initial focus, even though we have ambitions over time to create liquid versions of those sub-strategies, if you will, of PE, what Randy is going to describe is leverage buyouts, right? The classic business that was invented by Clayton Dubilier, whatever, 25 years ago. So Randy, go for it.
More than that, and absolutely great point. So I'll say liquid PE, but I mean liquid LBO. And down the road, when we do liquid real estate, liquid venture, etc., obviously that's all part of the story. But you have to start somewhere. You want to do one thing right, really get it right before you say, oh, now we're going to do 5 other things. And we think LBO is the heart of private equity. I should also mention, because you asked about the terminology, and sort of is an oxymoron. The way I like to think of liquid private equity is the way I think of Diet Coke. Diet Coke is not exactly the same as Coke, but it's the closest you can get to the flavor of Coke while being a diet drink, right? And we feel like we're as close as you can get to all the benefits that private equity offers while being liquid and accessible. And so that's why we call it liquid PE. And the key is, it's not just that we're saying, oh, let's try to match their performance with some unrelated strategy. The goal is to do what private equity does to the greatest extent possible, and therefore add value for investors in the same way private equity does. And so you can think of a 3-step process, and that is buy what they buy, lever like they lever, and then protect the downside. Okay? Buy what they buy, lever like they lever, protect the downside. And there's sort of a step 0 that goes before step 1, 2, and 3. And step 0 is get the data. And we mentioned before, Preqin is a data source. There are a number of available data providers. We think that we have really, the best data in the world on this subject. We work with one of the world's largest firms in the private equity space that has access to data on every deal and deep data. And we think that's hugely beneficial, because some of the other data providers provide more surface level data. So we're really excited about having the quality data to do the analysis, because as I say, you need to buy what they buy. Now, obviously, buy what they buy doesn't mean buy the private companies they hold. Not only are those companies not for sale, but if you did buy them, you'd be just as illiquid as private equity. So the idea is to learn exactly what private equity is doing at any given moment, and also historically. So you need to go historically back 25 years. What has private equity done quarter by quarter, so that you can test theories on how private equity behaves? And then you need to every quarter get updated information. What is private equity doing right now? And then you say, okay, let's buy a portfolio of public companies. Let's say, just for concreteness, we have different products with different numbers of positions, but think in terms of having maybe 250 positions in the portfolio. So there's about 7,000 positions in LBO funds, right? So think 1,000 LBO funds with 8 or 10 positions each, but some positions are in multiple funds, right? You get multiple investors in a deal. And so you might get about 7,000 positions total. We're going to create a portfolio of 250 or so public companies that is as similar as possible to that portfolio of private companies. And so we're going to take a systematic approach to analyzing the PE data and then saying what are the most similar public companies. If you want to drill one level deeper on that buy what they buy, what you'd say is two crucial elements. The first is you're going to have the same industry tilts as private equity. Because private equity, if you look at what they hold, it doesn't look at all like the public markets. Like in the public markets, healthcare and banking are similar sized, sectors of the economy. In PE, there's 15 times as much healthcare as there is banking, right? So and remember, this isn't just one particular fund loves healthcare. This is across all 1,000 funds. So if you're gonna say you're liquid PE, you need to match the industry distribution of PE, and that changes all the time. You go back a couple decades, software was one of the biggest underweights in PE. Now it's the single biggest overweight, not just the biggest sector, but the biggest overweight among all sectors. And who knows, 5 years from now, it might be back to market weight. So you have to keep up with what's going on in PE. And it's crucial to do it because it turns out that PE is fantastically good at picking industries. And this was first shown I was teaching at MIT, and I had the good fortune to have a wonderful colleague there, Mark Kritzman. He's done terrific research in this area and showed that private equity, if you look at those industry tilts, they lead to very significant outperformance. And that was 10 years ago. So we've had 10 more years to look at that data. And so it's very, very powerful to match the PE industry tilts because first, that's what makes you true liquid PE. And second, it captures arguably PE's biggest source of alpha. And then within each industry, you're going to have to buy the kinds of companies PE buys. And this is what we call LBOable companies, okay? And I could go into a lot of depth in this, and if you ask me to, I would love to. But let me start on the surface level, just so I don't spend half an hour answering one question. And on the surface level, think high profit, low multiple. That's what PE buys. That's what you have to buy if you want to be able to make the interest payments associated with the leverage in LBO. You need a lot of profit, and then you need a low multiple so that you're not paying so much that all those that more than 100% of the profits are needed to cover the interest. And so you're going to, and guess what? Those are the highest performing kinds of companies in the public markets, is high profit, low multiple companies. So you're in the right industries. That's the biggest source of alpha. You're in the right kinds of companies within each industry. That's the second biggest source of alpha. So you've captured a lot. And then you can match the leverage of PE. And again, we can get into this in more depth. It turns out, look, public companies have debt. And LBOable public companies, the kind that I'm describing, those are high debt capacity companies. They have more debt than typical public companies. You only need to put 0.3 or 0.4 turns of leverage on those public companies, those LBOable public companies, to get to a similar leverage amount that justifies the L in LBO, right? And so we do that, and that adds meaningfully to performance. It gives you a risk return profile that looks like PE. And then finally, you're going to need to use derivatives to match the downside protection that PE offers. As Jean-Louis noted, PE is able to use mark-to-model accounting. Think of the COVID quarter. COVID hits, the market crashes. PE looks at the situation and says, you know what? Obviously, COVID is bad for the economy and it's a terrible scourge to humankind, but we think the market is overreacting in how far it dropped. We don't think our company's values have dropped that far. We look at the profits, we look at the revenues. We think things are bad, but not that bad. We're only down 10%, right? Now, with the S&P down 20 and the L and LBO standing for leverage, you might have thought PE would be down, between 20 and 35%. But instead, PE marked only down 10% that quarter, right? And it turned out PE was right? The market came back and recognized, you know what? We took it too far. So PE got that one correct. But fundamentally, my friends who run mutual funds are a little frustrated. They say, yeah, I also thought the market was overreacting and crashing so much in COVID, but I had to take the markdowns. And we'll have to take the markdowns. We're buying public companies. So we'll take those markdowns. So we need to hedge in order to deliver the powerful benefit of that smooth performance profile that PE offers. And you can hedge with put options. You can use managed future strategies. There's all kinds of interesting hedging strategies. We work with the best derivatives firms in the world to develop ideal hedging strategies that are not too costly and that give you the smooth performance profile of PE. And that's the approach. And sorry that answer's so long, but it took 20 years to think of all that, so it takes a little time to explain it.
Well, it didn't take 20 years to explain, so that's sort of good. 20 years of research all in a few moments. So thank you for.
That's what we do here at HPS.
Yeah. So look, a lot of questions from this, but I think what comes straight out is, how are you analyzing the private equity market to make decisions as to where to invest? Are you taking the global private equity industry? Are you taking US private equity industry? How are you coming to terms as to where to play?
No, your turn.
No, I think the short answer and then is right now we started with the U.S. And that's the universe we're analyzing. That's the subset of the private markets and private data. But we have done some preliminary work on global. Looking at Europe, obviously, the European market, LBO market. We think the same model that Randy described is gonna work from the so we're planning to expand it globally. But if I may, Alex, I don't want to I was going to go a little bit on a tangent because, as we gave you an overview of liquid PE, one of the questions we always get asked is, hey, it sounds like you're doing all those things, but, PE does other things that are amazing, which is, operational improvements. I mean, look, I know exactly on the distress side, we were doing all this, as well, and turnaround. And so I know exactly the work that goes on. And so there's a bunch of value added, significant value added that PE delivers that we can't deliver. And I think it might make sense to explain, how our performance, potentially can look like, versus PE, because we have significant disadvantages, but without I'll let Randy kind of probably kind of put it together for you, because I think that's a useful kind of piece of the puzzle.
Yeah, that's right. PE adds value many ways, right? And we've listed a bunch of them, right? Great at picking industries, great at being in the right kinds of companies within industries. They use leverage to boost performance, but it doesn't lead to risk running out of bounds because of their ability to smooth performance through mark-to-model accounting. And so that's very powerful, and it's a great model. And as I say, we can match the first three, and we can match the smoothness, but maybe at a cost. Look, we're going to try to develop with our partners derivative strategies so good and have worked hard to develop that they don't lose money on average. But I think a reasonable conservative person would say you should assume you're going to be a little bit behind for paying for those derivatives, right? In other words, if you're going to buy fire insurance on a building, you expect to lose money on the fire insurance over the course of years. Maybe sometimes there are fires and you collect some premium and you collect some payouts, but the premium is going to exceed that because the fire insurance companies are profitable. And so in general, when you buy downside protection, you expect to lose a little. So we should probably underperform PE by a little because of that. And then additionally, PE is able to use inside information to find the very best companies. So in other words, even after they've identified, hey, we're going to be 15% healthcare. And then even after they've said, we're going to be in the high profit, low multiple, high payout ratio, low risk, small companies, which are the best performing companies in that space, then there's still a bunch of them. And then they pick the ones that, based on knowing stuff about future earnings of the company, about patents that may have been filed that haven't been publicly announced, they've got better information. No public company is going to tell us any secret inside information. And if any of them ever accidentally did, we wouldn't be allowed to buy the company. Of course, we'd have MMPI. So that's a second disadvantage we have. And then a third disadvantage we have, as Jean-Louis highlighted, is, of course, look, I've been sending my best students off to these LBO firms for 25 years. These are amazingly talented people. They work super hard and do an incredible job. And they make these companies better, right? And, that may be something as simple as implementing best practices. You may have a company that's very well run overall, but doesn't do inventory management as well as they can. And they add that. Maybe they're new technologies that they should be adding to the mix. They can take local companies, national or global. They can do roll-ups in which they combine companies and get streamlining and efficiencies. We're not going to be able to do any of that. Even if we manage billions spread across hundreds of companies, it's not going to be large enough to affect the management of those companies. So that's a real disadvantage to us. And frankly, it might be a deal killer if it weren't that capitalism is so effective, right? But what happens? You have mom and pop. They run a chain of 17 stores in the Pacific Northwest that people absolutely love. And a PE firm sees it, says, wow, we could take this model global and make this hundreds and hundreds of stores, incredibly valuable company. They call up mom and pop and say, we'd like to buy you out. We'll pay you $350 million. Mom and pop say, hey, great idea. Talk to our banker at JP Morgan. Let's run a process. We'll get 6 bidders in here and we'll sell to the high bidder. And hey, we hope it's you because you guys came to us first and we really like you, but we've got to give other folks a chance. On average, this leads to a control premium in excess of 30%, according to the Bain study. And I think other studies have backed that up. And so what way you can think of it is operational improvements are adding a lot of value, but most of that value is going back to the previous owners, to mom and pop. In my example, through they get most of the value of those operational improvements, and they deserve it. They created the opportunity, but a decent chunk of it goes to the investors. And we would argue that, look, those options and other derivatives that we're going to use to hedge will make money some years, lose money most years. On average, probably lose 1 or 2% a year of them. We'll probably lose 1 or 2% a year relative to traditional PE because of our inability to take advantage of inside information. And finally, if you net out the control premium from the operational improvements, that's probably another setback for us of 1 or 2% a year. Not that we lose it, it's just something PE does that we can't match. And you add that up, 1 to 2 plus 1 to 2 plus 1 to 2, we're 3 to 6% behind traditional PE. And you know what? If you look at our historical results or our tested results, you go back, you'll see that we do underperform traditional PE on a gross basis. But here, what saves us is the very thing that attracted my superstar students to go work for LBO, which is it's a very highly compensated area of the capital markets. And it's highly compensated through fees that once you add up operator fees, monitoring fees, origination fees, management fees, and carried interest, CalPERS found that even for them, who's better positioned to negotiate than most of us, they pay 700 basis points a year in fees. And so if in liquid PE, you have products that are more like in the 100 basis point range, you can see that you could be meaningfully behind on a gross basis, but still on a net basis, match or even slightly outperform average traditional PE. And again, it's not going to get you up to that top quartile, but as a tool in the toolbox, you can get to average PE because that control premium cost and the fee costs net out against the big advantages the PE has over liquid PE.
Okay. So that makes a lot of sense with regards to the build out. So just looking at the strategy in perpetuity, are you looking at as a similar ratio as private equity invests 70%, 15% of private equity capital is in healthcare, 22% of it is in manufacturing. Are you going broad across that, building a whole portfolio on the base of that, or are you going, we're creating a healthcare investment vehicle and we're going to find X amount of companies in that healthcare space? Is that the strategy? Well, which one of those would be the strategy?
Yeah, right now it's the former. So we're broadly trying to say, hey, we think PE is adding a lot of value through getting these industry picks right. So we want to match those tills. Of course, if somebody, if a pension fund calls us for a big managed account and says, hey, we're really strong in all the areas except healthcare, can you create a healthcare liquid PE? We're happy to engage that conversation, but that's not what we do at this point. Everything we do is broadly across all the industries. And that helps, of course, too, when you go to the prime broker and say, hey, we want those 0.3 or 0.4 turns of leverage. They look at it and say, well, you got hundreds of companies, you're across all the industries, and you're hedged. They're very, very comfortable lending that money, at a very modest rate, just a tiny bit over SOFR, because of that. Obviously, if you came with something that was specific, like healthcare, then, that would be a factor to be taken into account. But that's not something we've built yet.
Not only am I the host of the Private Equity podcast, but I'm also the founder and managing partner of Raw Selection. Raw Selection is a private equity specialist executive search firm with 2 divisions, one that focuses on portfolio, C-suite executive hires, and one that focuses on private equity direct hires of the back office and investment deal professionals to the industry. Alongside the podcast, we're passionate about giving back to the industry and giving people information that they can run and utilize. One thing we do regularly every year is we run salary reports on accurate and live data of people that we've interviewed and people that have shared their information with us. So if you're looking to compare your current compensation or your compensation for your next hire in your private equity firm or portfolio company, then please check out our YouTube channel and see the playlist of salary surveys. Okay. And so what are you, I think there'll be a lot of people screaming at the podcast right now and seeing what trends you're seeing, because you guys have an insight of private equity at a real holistic, sky view level. What are the trends? What are the areas? What are the sectors that you're seeing investing in most? Or is it just classic healthcare, manufacturing, business services? What's your take on that?
Joey, do you want to jump in on that? I can say something if not.
Yeah, no, I can jump in. You can jump
I
in.
feel like I'm stealing all the airtime, so let's.
No, but I think obviously, the as Randy alluded to, what's been obviously the evolution of private equity, which is pretty amazing, is to see how much software and services now dominates. It's 30% of our portfolio, because that's exactly kind of what the number is in private equity. And as Randy said, and it gets back to kind of the wisdom of private equity in industry selection, right? Because what happens is, if you're in the public markets, as Randy says it all the time, and your Fidelity and your investing, you get all those companies pitching you and saying, we're great. In the case of private equity, they own those companies, so they know exactly what's going on, and learning about all those industries at an amazing level of interest. So it's always kind of really smart to, if private equity is starting to divest from energy and starting to invest in another sector, those are kind of really interesting trends. And you go back, back to the software and services example. It's pretty staggering because, as Randy said, 20 years ago, 25 years ago, it was zero. That those companies were vaporware, right? There was no, there was no profits. There was no, and so those are kind of very significant trends to kind of be aware of. After that, to be honest, I think we just we're just getting started with all the data that Randy has referred to. We have access to really amazing data, and so we'll be at the front line of kind of understanding a lot of those trends. But as importantly, one of the areas of research, which, and I'm just opening the door to a whole other conversation here, but what Randy has described is we take the data of all leveraged buyout funds. The reality is, what we're super excited about is to potentially get insights into what the top quartile funds are doing, right? And maybe, in fact, even just around industry selection, they might be kind of some funds that are really, really kind of super much better than others, and kind of get zero in could give us some adjustments to the model where we're going to get even better, right? Because, as you know, it's an industry where there's a lot of dispersion around the mean, right? If you're in the top quartile fund, your performance is going to be 10% better annually than the 12% I gave you since the turn of the century. That's a massive kind of difference. And the other way around, obviously, bottom quartile is not so good, right? So, anyways, Randy, I preempted your thoughts.
Yeah, I think that's great. I agree with Jean-Louis that the real shocker is how PE crushed it on the software play. In other words, they saw in the late aughts, early teens, I guess, that software was changing from something that people used to have vapor, where you'd have these companies and like, oh, they had a great story, they had cool looking software, they never made any damn money, right? And that changed, and PE saw it coming, and they started to invest in those companies, and they've made a fortune. And I think a really meaningful part of the fantastic returns of private equity over the last decade plus is them getting that call right. And the interesting question, of course, will be at what point, if do we reach a notion where people say, you know what, software is fully priced, the rest of the world has caught up to what PE realized early, which is that this is a great sector. But there's fascinating things going on in other sectors too. You look at banking; it's so low. And it sort of makes sense, right? Because if you think to yourself, one of the ways that private equity adds value is by seeing opportunities to add leverage to a company in an efficient way, and improve returns that way. Well, most banks, they're kind of already pushing leverage to the max. That's part of the business model. And so what we see historically is that there are moments when, due to regulatory changes or for other reasons, there's an opportunity where bankers are not maximizing, and the PE firms come in and buy them up. Again, maybe sometimes mergers or do other things, and you see banking become a meaningful part of PE portfolios. Right now, it's very low. There's nothing brewing, at the moment that I know of. But if you start to see that change, that's something to be aware of, because it'll come through in the public markets too.
Okay. Have you guys got any? Well, I mean, it's the crystal ball, but if software's had its day, if it's not, nobody will truly know. What do you think will come next? And if you want to tell me you don't know the answer to that question, that's fine.
Be very upfront that I am not smart enough to figure out what industries will do well. That's why I was so happy when I realized hey, there's this 1,000 geniuses out there, and not and you get the wisdom of crowds benefit of seeing when you combine what all 1,000 of them are doing. Let's just copy those allocations. And it's not like they're all just stampeding into one thing, right? They're diversifying, they're recognizing there's opportunities all over the map, but they're getting the percentages right. And so that's why we copy that. I joke, not smart enough to ace the test on my own, but smart enough to copy off the kid next to me. But in this case, I don't think we're doing any disservice to PE, right? No, it's PE is going into those businesses, and then we're saying, hey, we'll buy public markets companies in those same industries. So, I don't think we're taking advantage of PE's kindness in kind of publicly announcing their deals. We're not hurting
Interesting. So, okay, this is really interesting. Certainly an interesting strategy as to what you guys are going through there. I want to dive a little bit into both your profiles because you both got interesting backgrounds. But before I do, I want to make sure we've closed off liquid private equity. Is there anything else you guys want to share about this to help everybody listening further understand or glean even further from it?
I think that's a pretty good overview, right, Randy?
I think so. I think we got to, the key points I'd love people to take, when we teach a class, we try to summarize at the end so people get the key takeaways. And, key takeaways are, that we think we can be helpful to allocators as a tool in their toolbox. That, we support the private equity industry. We think they're doing a great job. And we think that with our help, allocators can maybe even invest more in private equity and make better choices. One thing I guess we didn't get to mention was just how advantageous it is to have a great funding asset for your PE. In other words, imagine you have a range. You're supposed to be 20% PE in your pension fund. So just so we can do the math in our heads, it's a $100 billion pension fund. They're supposed to have 20 billion in PE. What we've been told over and over by allocators is that they're going to be 17 to 19%, 17 to 19 billion of PE, and 1 to 3 billion sitting in the funding asset waiting for deals. And what they've said is, moreover, when that funding asset starts to creep up towards the 3% level, there's a lot of pressure to get the money to work because otherwise you're just having a cash drag from that money sitting on the sidelines. And so then if they meet a fund the next week who in their opinion offers average performance expectations, they're going to tend to say yes. One colleague of ours who used to run a big state pension fund said, I meet funds I think are great, I meet funds I think are average, and I meet funds I think are lousy. I've never given a dime to someone I thought was lousy, but I put a lot of money into funds I thought were average, and I hated locking up for 10 years with average. And by the way, of course, he knows he's not always right. Sometimes he thinks they're great and they're average. He thinks they're average, they're great. But he said he hates locking up for 10 years with people who he thinks are probably going to be average, but you've got to get the money working, right? But if you have a funding asset that delivers average PE returns, then you can say no to anyone you think is average. And then when the great one comes along, again, the one you think will be great, which you won't always be right, but you'll be right more often than not. That's when you can make a big investment and get a higher percentage. We hope to help allocators go from having, let's say, 30-35% in top quartile funds for a really smart allocator. Maybe they can get to 40-45% with the patience that they'll be able to have with a better funding asset.
Makes sense. Thank you for that. So Jean-Louis, I'll kick off with you. You've got a very interesting background on the basis that you co-founded SVP Global. There's a million questions and probably a whole podcast I could do around that. But with a lot of private equity managing partners listening that don't get as much insight into large billions and billions assets under management, unless it's a Steven Schwartzman or David Rubenstein on TV, what would you share with us about that journey and your learnings, if that's not a massive question that will take 5 hours?
No, I mean, I think that maybe kind of the short answer. I mean, yeah, as you said, it's a heck of a journey because we started SVP about more than 20 years ago. Victor and I were going to Kinko to print the pitch decks. And him and I had really kind of no idea what it takes to build, one of those significant kind of, alternative private equity firms. I mean, Victor was him and I shared the background. We were both strategy consultants at Booz Allen. So, that's a little bit of kind of the heart of the skill sets. Is how to take apart businesses, understand what drives them strategically, and so forth. And that's what you do also when you do distressed investing. It's even though it's through the debt side, you have to kind of really understand enterprise value and cash flows and kind of ways to improve and position companies. But yeah, starting it's a heck of a journey to kind of start building a large alternative firm, and particularly also to do it in a way where you don't compromise kind of returns, because obviously as you get to milestones of assets under management, it's one thing to manage $1 billion, it's another thing to manage 26. And in our business, we've always focused on sourcing and kind of creating advantage by creating kind of a pipeline of sourcing away from Wall Street. So that was a lot of what we do. But the other kind of relevant experience as well is you start learning. Victor used to run the stress desk at Merrill. He had prop capital. That's easy. When you run a firm and build a firm, you start realizing that half of your time is going to be fundraising, because otherwise you don't have any capital to invest. And that's super relevant to, in fact, liquid PE, because what Randy has described is it's having the understanding the needs of the allocator is something that I experienced firsthand at SVP. We used to get calls from the big allocators all the time, just saying, when are you going to sell your position in Kotler Pentaplas? Because we need to know when we're going to get our money back. And then the following day, you have another fund calling you and saying, when are you going to call capital? Because I have this commitment outstanding and I'd like to know. So you wind up having kind of having to understand the needs of all the allocators, and which is super relevant to obviously what we're doing with liquid PE. Hopefully that was not too long-winded and helpful.
I think we could go for hours on that and discussing it. So I appreciate you keeping it to a concise level. And for you, Randy, obviously an interesting role as a lecturer at Harvard. You mentioned the people that you teach go into the private equity industry. So what's your take on that from a lens of Harvard?
Yeah, look, it's I'm just so fortunate to get to teach here. The students are incredible. The ones who have interest in PE, many of them have been working at PE for several years before they come here. A common path is to do an investment banking program right out of college, then get a PE job, do that for 2 or 3 years, and then come here. Some of them now go straight to PE, of course, from college. So I'm in a room with 90 students. There's a wealth of experience in there that I get to learn from. And so that is extraordinary. And then, of course, I now have about 5,000 former students out on Wall Street, and I'm not in touch with all of them by any means, but they all know that I'm fascinated by investments, fascinated by private investments, and any kind of special opportunity. Reach out to me, tell me what's going on. If you see something cool I could write a case study about, I write case studies about fascinating investment opportunities. Sometimes I invest in them myself. I tell friends about them, and so it's a wellspring of information about what's going on. And look, look, Harvard's a wonderful place, and the name brand is great. And as a result, people, if I get interested, if I read about something in the Wall Street Journal that's amazing, if I, reach out to the people involved, there's a good chance they'll talk to me if I say, hey, I might want to write a case study for Harvard Business School. And so it's a great, just a great platform from which to learn and to keep up with everything going on in the investing world.
So other than each other, which I'm sure you've got hell of a stories to tell, and your insights into private equity and everything else from there, what are your influences? What do you guys read, watch, listen to that you recommend that our readers check out?
Um, well, I'm going to mention a thing or two that are not specifically private equity related, but are just fantastic. Which is, I think you could argue that the single best thing on the internet is a blog called Marginal Revolution. Maybe a lot of your listeners are familiar with it, but in case they're not, it's run by 2 economics professors at George Mason University, Tyler Cowen and Alex Tabarrok. and they are just every day there's a dozen posts just full of insights about the world, and some are about finance, some are about economics, some are about culture and other topics. Some of it's academic inside baseball. Some of it's just incredible books that you might want to read, or if you don't have time to read, you're at least glad that you read a little bit about them. And I learned so much from it, and it guides me to other things that I should learn from. I'll throw that one out as one that maybe not everyone knows out yet, but people should check out. It's at marginalrevolution.com. They were very early on the internet, so they got a good not too complicated web URL, and check it out.
I've not heard of that myself, so I will check that out myself. Jean-Louis, what about you?
No, I mean, to be honest, I should be more of a reader. I listen to, I do it secondhand through Randy. It was this amazing ability to kind of digest a lot of different books. I mean, the last book I read, which it's always interesting to get. I'm always at heart an entrepreneur. I keep starting new businesses, and so I read the book by the founder of Nike, which is a fun read, which I'm sure a number of your listeners have read, but always interested in everybody's entrepreneurship journey. That's always been fascinating.
If we're doing books, I'll just mention there is a fiction writer who's my favorite writer, and he predicts the future. It's unbelievable. His name is Neil Stephenson. His most famous book is from the 1990s called Snow Crash. And that's a wonderful book, which is the book that invented the concept of the metaverse and an avatar, and named those. But it's he wrote a book about cryptocurrency in 1999. Called Cryptonomicon, one of the best books I've ever read. And again, that is long before Bitcoin became a thing. Not just before everybody knew about Bitcoin, but before Bitcoin even existed, he was writing about it. I was talking to a guy in the education technology world, and I asked him, have you read Neil Stephenson's The Diamond Age? That's the book where he predicted the iPad. And he said, he didn't predict the iPad. I'm like, what do you mean? He wrote that book in 1995. The iPad was in the 2000s. He said, no, he didn't predict the iPad. He invented the iPad. I'm like, what? He said, yeah, he wrote the book, and Jeff Bezos also likes Neil Stephenson. And they both live in Seattle, so they got lunch, and Bezos said, let's create this. And that's where the Kindle came from. And the iPad is a better version of the Kindle. And he's still writing books and still predicting the future. And I mean, I want to be clear. These are the most entertaining novels I've ever read in my life. And then also you get the benefit of getting to see the future. So Neil Stephenson, Neil, N-E-A-L, and Stephenson with a P-H. Highly, highly recommended. All his books are fantastic.
Neil Stephenson, the man who predicts the future. Oh, well, I'd like to know what the lottery is going to come up with us next week. That'll be useful.
Can I say one last thing, just because you mentioned your audience has a lot of private equity managers. Obviously, a lot of what Jean-Louis and I have said is why we think our product is useful to allocators. But Jean-Louis hinted at one thing earlier, which is, look, nobody's done this yet. But if somebody's out there running a private equity fund, think about the following. Let's say you're going to go raise a $10 billion fund for your next raise. Think about doing this, saying, hey, $7 billion of it, we're doing the normal way, drawdown vehicle and so forth. But $3 billion, we're going to partner with our friends at PEO Partners. And here's what we're going to do. Just put the money up front, right? You're putting in 10 million, just give us 10 million. We'll put the money in liquid private equity and get average PE returns. And then we'll do the drawdowns whenever we need them to invest in a true traditional PE company. And you won't have to think about capital calls. We'll just manage the whole process. And we really think it makes a lot of sense for somebody to partner with us on that. We don't spend a lot of time, talking to PE managers about it, because it's not the product that we have right now, but we'd be ready to do that. And I think for somebody to say, yeah, just take a little piece of what they do and try it, it might be game changing. And so that's because if I were a PE manager, especially one who'd been doing it a long time, I might think, boy, how do I create terminal value in this business? How do I make this a business that isn't just I personally am a genius, and when I retire, the whole thing is worthless? This is a way of creating something that has permanence to it. So if anyone out there listening is interesting, reach out to us.
Absolutely. So my next question is, how do they get in touch if they do want to speak to you? So that's a nice pivot
There you go.
into that one.
Zoe?
So, Alex, are you looking for email address or?
Well, websites, LinkedIn's, whatever.
Yeah.
Guys, I don't think you probably want your cell numbers and emails plastering all over the internet. There's 19,000 downloads last month, but however, whatever you guys are comfortable with sharing.
Yeah. I mean, it's the website is www.peo-partners with an S, peo-partners.com. And I think you can find us that way, right, Randy? That's easiest, yeah.
Yeah, and we're on LinkedIn, and we'd love to hear from people. I generally do a webinar once a quarter where I try to share all those insights that I said I get that I'm so lucky to be in the flow of here at Harvard Business School, from the students, from my colleagues, from alums. I try to every quarter share what we think is going on in the markets. It's not a pitch for PEO Partners or anything like that. It's just a way of showing that we're really paying attention to what's going on and trying to be forward thinking. And so if there's folks out there who'd be interested in attending those webinars, we'd love to hear from you. So hit us up on LinkedIn or through the website.
Thank you very much. And thank you very much for you both joining us, giving us an insight into Liquid Partners, into SVP Global, into Harvard Business School, and everything else that we've discussed. So appreciate it. It's also the first time we've had, I'll say three people technically, on the podcast, albeit I'm usually just here as a passenger learning from you guys. So thank you very much for you guys joining us.
Thank you.
Thanks so much, Alex.
And also, thank you very much to all of our listeners for yet again tuning in to the Private Equity Podcast. Till the next time, keep smashing it, and thank you very much for listening.